So, welcome to chapter four. Chapter four starts off with really more explanations of some generally accepted accounting principles that we're going to be focused on today. Um, and then it goes on to doing some interesting accounting and then a whole bunch of accounting. Most of the work that we're going to be doing in chapter four is going to be on that in the very last objective. So be prepared. And this is a ton of work. Objective four, learning objective four in this chapter. But today we take it easy with some interesting concepts to understand about accounting. So first of all, what you're learning are some of the rules that are part of generally accepted accounting principles. And one thing that you are learning how to do in this class is something called the accrual basis of accounting. What we actually are doing is called the accrual basis of accounting. There's another way to do accounting that actually a lot of businesses do called the cash basis of accounting. But as a public corporation, and that's what this book is based on, for the reporting standards that are part of generally accepted accounting principles, they have to follow this basis. They have to do the accrual basis of accounting. So that's what you're learning. Okay. And so, interesting enough, what we are really practicing here is part of generally accepted accounting principles based on something called the periodicity assumption. The periodicity assumption, if you remember way back from chapter 2, you were introduced to this concept. Accountants need to divide up the life of a business into these artificial time periods. And there's really three time periods that we break the business into. We break businesses into monthly time periods. So we measure, for example, profit and loss on a monthly basis. We also measure how things are going by the quarter. A quarter is a 3-month period of time. Okay. But the most we will do in accounting is keep records for a year's period of time. That's the most. So in terms of record keeping, which is accounting's basis, right? The shortest record that you will have available to you would be the monthly record. What record specifically? The income statement. Okay. The income statement is a critically important statement because it's the only statement that tells owners whether they made a profit or a loss. And as an owner, I can't think of any more important statement that I want to know about. Did we make a profit or did we have a loss? So those records are definitely kept monthly. The longest we will keep records, however, of profit and losses is a year. And after a year's period of time, we have to keep those records separate. So for example, the definition of a year in a business could be what we call a calendar year. And a calendar year is the year that you and I are most familiar with because it begins on New Year's Day, January the 1st of every year, and it ends on December 31st of every year. So that's the calendar year. And again, that's the longest period that a business could measure. They could use the calendar year as their year. But because the calendar year is very specific, January the 1st to December 31st, not all businesses want to report out to their owners what the profit and loss is for that period of time. For example, it doesn't make any sense to force a retail company who is still in the midst of Christmas shopping season on December 31st. After Christmas sales are just as big as before Christmas sales. So retail is buzzing still at that time. It doesn't make any sense to force a retailer to stop everything that it's doing on December 31st to report out its profit and loss because it's busy. It's busy. It's in the midst of their busiest season. So then what can retailers do? Well, retailers don't have to use the calendar year. They can use something called a fiscal year. And a fiscal year is simply a 12-month period of time that can be used for accounting purposes. And a fiscal year it's got to be 12 consecutive months. Can't skip any months. But for example, if I were Walmart, um, or Target, or a company, a department store that's very, very busy around Christmas time, then I probably would want to be sure that I'm reporting out to my stockholders the profit and loss for the year after my busiest season is done. So if my busy season, which is the Christmas shopping season, isn't done until sometime in late January, because after Christmas sales go into at least mid-January, um, I probably don't want to report profit and loss until the end of January or around there, because then I can actually be more honest and accurate with the owners. This is how we did this season. This is how we did this year. This was our profit, or this was our loss for that year. And that's important. So I could use a fiscal year, for example, of February the 1st to January 31st. Again, it's still a 12-month period of time, but I measure my 12 months from February the 1st of every year to the following January 31st of the following year. So 12 consecutive months. Okay. And that could be a fiscal year. What if I'm a seasonal business? We live in a part of New York where we get most of our tourists here in the warmer weather. No one wants to visit around this time of year because most of whatever we do have for is closed or cold. It's hard to do the walkway in below freezing temperatures. It's hard to visit the Vanderbilt estate or other types of places. It's better in the warmer weather. So we have seasonal businesses like motels that are only open for several months of the year, and they close when the weather gets cold, say in the end of October, for example. So they might have a fiscal year that closes October 31st. Well, if you close your record of the year on October 31st, you have to begin your records November 1st. So that would be their fiscal year, November the 1st of this year to October 31st of the following year. And they have to keep that regularly. So a year can be measured either in the form of a calendar year or a fiscal year. There are some businesses that don't have busy seasons, like retail, or seasonal businesses that are only open during, say, warmer weather. So, for example, a dental office would probably use a calendar year. They have no reason not to use a calendar year for their accounting records because there's no big season. It's not like they're having a Halloween cavity special, and they're really booked in November. I think in essence, a lot of businesses can simply use the calendar year because it's relatively steady year round. But for those businesses that have these peaks in their year, they can decide to use a fiscal year. And it's important because it's a period of time. Periodicity is about those artificial time periods, right? And no statement is more important in telling us about that period of time than the income statement. Remember, when you look at an income statement, it'll say for the period of, right, for the month of October, for the year ending, December, whatever. So the income statement is really critical. And of course, everything that happens on the income statement will also flow into the retained earnings statement, which is also based on the periodicity assumption, because like the income statement, it's measuring the exact same period of time. Okay. So that's really critically important to understand periodicity and how we break things up. The shortest period we measure is a month. That's important to know. The longest period we measure is a year. And we have to keep these records separate year to year to year. In order to keep those records separate, we have to basically close out our income statement accounts. Our revenue and expense accounts at the end of every year need to be adjusted to reflect the next year starting at 0. So if we did use a calendar year and we closed our books on December 31st, the very next day, January 1st, the revenue and expense accounts have to start at 0. So we can keep those records separate for that year compared to what happened this year. And so that's what you're going to be learning about here in this chapter. Generally accepted accounting principles have principles. One of the most important ones is something called revenue recognition principle. This is part of GAAP. Corporations have to recognize revenue when they do the work, okay? Not when they get paid for the work, but when they do the work. That's what they have to do. They have to recognize revenue on the day and in the time period in which they did the work or in which they sold the good, okay? If it's a different type of a business. So that's revenue recognition. We recognize revenue on the day that we do the work or that we deliver the goods, okay, to the client, regardless whether we get paid for it or not on that day. So here's an illustration of how that works. You have a dry cleaner and they clean clothes for a client on June the 30th. The customers don't come back until July to pick up their clothes. So what would they need to do in their journal? Well, under the revenue recognition principle, they did the work on June the 30th. And so literally in the journal, I'm going to fill this out here, on June the 30th, they have to recognize that revenue. They will set up an accounts receivable because they clearly haven't paid for the clothes yet, but they did the work that day. If you did the work that day, that's your revenue. For a dry cleaner, that's the revenue. So you have to recognize the revenue on the day. So this is important because this happened on June 30th. Remember, we also keep monthly records. So whatever happened in June needs to be part of June's records. And clearly, this is important because this is the day we earn the revenue. Okay, so the revenue will be reported in June on these records because that's when we actually earned it. That's revenue recognition in action. Okay, clearly when they come back in July to pick up their clothes, they'll give us the cash, but the cash simply satisfies the receivable, right? We were waiting to receive their cash and here they paid it. Okay, remember, that's what receivable is. A receivable is you've already done work and you're waiting to receive payment for that work. The payment's always going to be cash because you're not going to accept anything else, right? So you'll always see receivable affected, accounts receivable is going to be affected when you did work and you haven't got paid for it yet. Right? But when you pay, when you get paid, you take the receivable away. Of course, not to leave out expenses, expense recognition principle is quite similar to revenue recognition principle. The expenses have to match when we earn the revenue. So if we paid rent in June, then the rent expense has to be in June. It can't be in July, can't be in May, because it's for June. Okay, for example. And so it's important to understand that this is how we have to recognize things. This is the accrual basis of accounting. So look how much of GAAP you've learned already today. Okay, everything that we're doing is based on that periodicity assumption. The periods of time are monthly, quarterly, and yearly, and it affects basically the income statement the most because the income statement is reported out monthly, quarterly, and yearly. Because it affects the income statements have revenue and expenses, and so you have to have these principles down. We recognize revenue when we do the work. We recognize the expense in the period of time in which the expense happened. Okay, and so these are critically important concepts to understand. Another important concept to understand is you're learning accrual basis accounting, which is exactly why we are studying the rules of GAAP. Okay, that's really bad um, handwriting there, so forgive me. But generally accepted accounting principles requires corporations to use what we're learning in this class. Okay, that doesn't affect other businesses because other businesses are not public corporations. So other businesses do not have to do their accounting based on the accrual basis. And again, the accrual basis is following the rules of GAAP, like revenue recognition and expense recognition. So what do other companies can use? They can use a cash basis. And what does that mean? That means basically they're only going to put down that they earned revenue when they get paid for it, not when they did the work, but when they get the cash. They're going to recognize expenses when they actually pay it, not when it actually matched a month, but when they actually paid it out of their account. And because they're not matching revenues and expenses, this is why public corporations cannot use the cash basis, is it doesn't match things well. And so public corporations are judged on GAAP, but private businesses, whether you're a sole proprietor or even a private corporation, if you want to use the cash basis of accounting, you can. As a matter of fact, most small businesses do. I would say almost all small businesses do. So if you're a sole proprietor or a partnership, or you have you incorporate it yourself and you're private, you're probably going to use the cash basis to do all your accounting records. It's easy that way because you can follow your cash easier than you can start recording all these entries through the day. But for public corporations, the standards are different. I think the standard is better under the accrual system. It actually tells you a better story of when they actually earned money and when they actually had an expense than the cash basis. And here's an example why that helps. Let's say we have a company called Fresh Colors. And Fresh Colors is a company that paints buildings. So here we painted a building in 2016. So again, you did the work. When you paint a building, you did the work. Under the accrual basis, you did the work in 2016. Okay. Under the cash basis, you didn't do the work until you get paid. Okay. What also happened in 2016 is they had expenses. They paid salaries and they had to buy a bunch of paint, I'm sure, of $50,000. Well, under the accrual method, those expenses happened in 2016. Under the cash basis method, because you paid it in 2016, those expenses also happened in 2016. The customer is billed $80,000, but they don't pay until 2017. The fact that you billed the customer for work you did the work in 2016, that revenue is for 2016 under the accrual basis. The cash basis, they won't get paid until 2017. They're not going to recognize the 80,000 until 2017. So look what happens on their accounting records. Under the accrual basis, the revenue is earned in 2016 because that's when we painted the building. So the $80,000 of revenue is earned. The expenses of $50,000 also happened in 2016, so that's when the expenses are put down, and they have a profit of $30,000. Under this scenario, nothing happened in 2017 under the accrual basis. However, if a business uses the cash basis, they're only marking things down when the cash is paid or received. So clearly in 2016, they paid all those expenses, and so they recognize the expenses in 2016, but they don't recognize any revenue. In 2017, they got paid that $80,000 for painting the building. That's when they recognized the revenue. Okay. So again, most businesses use the cash basis, but we are doing public corporations. That's what this book is based on. You are learning the accrual basis of accounting, which is GAAP. And I think it paints a better, more accurate picture. So I think it is a good system to use. Okay. So like I said, we measure our profit and loss, revenue expenses for a period of time, right? No shorter than a month, no longer than a year. So what happens after that year is we have to basically close the accounting record for 1 year. So we can start a new accounting record in the new year. Keep those records separate. So in order to make sure we can close our records, which we also call closing the books, on 1 year, we have to double check that everything is accounted for. And that's basically what we do the adjustment process for. We do a series of adjustment entries that you'll be learning about later in this chapter that allow corporations to make sure all the revenue is accounted for and all the expenses are accounted for before they say, hey, this is our profit for the year. Right. And so basically, that's what the adjusting entry process is about. Make sure all the revenues and expenses are accounted for so their financial statements are as rock solid as they can be. Okay. And again, we're going to be focused on this coming up next class. The first thing you're going to be introduced to in learning objective 2 are these adjusting entries for something called deferrals. And deferrals basically are assets that turn into expenses once we use them, and liabilities that once we do the work, we earn it. So specifically, prepaid expenses are assets like, say, supplies. When you buy supplies, they're an asset. They're a current asset, as you remember. But after we use those supplies, we can expense what we've used. It becomes a supplies expense. So that's an example of a prepaid expense or an asset that turns into an expense. The liability account that's specific here is unearned revenue. Remember what unearned revenue is. The customer paid us up front. We owe the customer whatever they paid for. So it's sitting on our books as a liability. Unearned revenue is a liability account. But we have to check to see if we actually did some of that work. And if we did some of that work, it's no longer a liability, right? It's actually revenue, because revenue happens when we actually do the work. So it starts as a liability, but after we do the work, it ends up as our revenue. And so that's the first part we're going to be doing next time. And then learning objective 3 introduces you to these other adjustments called accruals. And accruals basically, again, affect revenue and expenses. Here, we have to make sure that all the revenue that we earned in a period is shown, whether we got paid for it or not. That's an accrued revenue. And you'll learn more about that next time. And an accrued expense is an expense that happened in this particular period, but we haven't paid it yet. So we have to make sure the expense shows up. Because again, notice every other word, right? Revenues and expenses, revenues and expenses, revenues and expenses. That's because the very first statement we do is the income statement. If we have to make sure those numbers are good. The adjusting process helps us double check to make sure all the revenue is there and all the expenses are there. So we can be pretty confident that our revenue and expense numbers are good, which means we're also very confident that the profit and loss is good as well, that we're reporting out as accurately as we can. That's the purpose of all this. Then once we do that, learning objective 4 is going to show you how it affects the accounts on the trial balance, because those adjusting entries are going to affect certain accounts. And that means it's going to affect the numbers in the accounts, the balances in the accounts, which then is going to affect the balance sheet, for example. So there's connections that you're going to be making throughout here. So all of learning objective 1 are about these concepts, and certainly very, very important concepts. Here you have the concept on the left side. On the right side, you have the definitions or descriptions. The accrual basis of accounting is what you're learning. We record things as they happen, not when we get the cash or not when we pay the cash. So accrual basis accounting is about that. The calendar year is that normal January 1st to December 31st year. that you can keep records for. It's not the only year a company can use. They can also use a fiscal year, which is any 12-month period of time, starting on X date, ending a year later. Okay. But the calendar year is common. Why are we doing all this? Because we have generally accepted accounting principles to follow. One of the most important assumptions is periodicity, right? We are dividing the economic life into time periods. What time periods? Monthly, quarterly, and yearly. The shortest time period is a month. The longest time period is a year. Well, we have to keep yearly records separate. Um, Apple's been in business for well over 40 years. For each of those time periods, they have to have separate records. Right. What records are we talking about? The records that are measured by time, income statement and retained earnings statement, but the income statement most importantly. Expense recognition, right? Expenses need to match the revenue. Um, Same with revenue recognition, right? We have to record the revenue when we earned the money, not when we get the cash. So that is an introduction to chapter 4, learning objective 1. Lots of interesting concepts to think about. And hopefully that helps you make sense of why we're doing the process.